Welcome to Business Engineering, and thank you for joining us. One unfortunate business statistic is that 20% of small businesses fail by the end of their first year. 50% have failed by their fifth year, and nearly 70% have failed by their 10th year. Let's explore the reasons behind why this happens, and better yet, how to prevent it. Let's check it out. Business engineering tackles complex management, technology, and business topics. We are unique in that we provide analysis and meaning by leveraging executive experience, evidence-based research, and doctoral-level academics to give you working knowledge to improve your business. The key points to explore, which serve as our research questions, examine business failure characteristics across small and medium enterprises. Specifically, what are the SME business failure rates? What are the primary reasons and the underlying causes of those failures? What is the economic impact? What can be learned from this? And can these failures be prevented? Let's start with a few definitions. The term SME is an acronym for Small and Medium-Sized Enterprises. It generally refers to micro, small, and medium-sized businesses. These are classified in different ways across developed nations, but as an example, in the U.S. it refers to a firm with less than 500 employees and less than $25 million in revenue. However, in Europe, the distinction is for firms with less than 250 employees and less than 45 million euro in revenue. The term business failure generally refers to a company closing its doors and ceasing operations because it has become insolvent. The symptoms of becoming insolvent are often that the business has exhausted its cash reserve and is not generating enough revenue nor profitability to pay its vendors, creditors, employers, or service its long-term debt. As a consequence, the business ceases operations. Let's take a look at the importance of SMEs and the role that they play in global economies. SMEs are a major component of the U.S. economy. The statistics below identify the level of contribution that they have to the U.S. economy in terms of employment, GDP, exports, and technology. Similar to the role they play in the U.S., SMEs are a major component of the global economy. They constitute about 95% of the world's enterprises, about 65% to 70% of the world's employment, and they hold a 50% share of the GDP worldwide. They also play a huge socioeconomic role. They provide local goods and services, as well as exports to help economies grow on the world stage. They employ billions of people. They serve to bring people, families, communities, and even nations out of poverty. And they pay taxes to contribute to the support of their jurisdictions. Let's look at the impact of small and medium-sized business failures. There is a wealth of data across various sources identifying the failure rates of SMEs and even dividing them by sector. As an example, new SMEs in the healthcare sector seem to be faring better than other SMEs. By contrast, restaurant businesses have a remarkably different longevity profile than other businesses. Overall, if we consider SMEs in the U.S., the data furnished by the Small Business Administration and the U.S. Department of Labor has identified that 20% of small businesses fail in their first year, 30% of the businesses have failed by year 2, 50% of SMEs fail by year 5, and almost 70% of SMEs have failed by year 10. The global failure rates are similar, with more than 50% of SMEs failing within 3 years. A few more data points of interest are that 82% of first-time European entrepreneurs fail, and only 25% of new businesses ever make it to the 15-year mark. If we plot these failure statistics graphically, it is very much an exponential decay curve. This graph contrasts the percentage of businesses still operating at the beginning of each successive business year. Let's look at the impact of small and medium-sized business failures. Earlier in this presentation, we discussed the importance of SMEs to the national and global economy, as well as the socioeconomic role in societies. Considering the vast $81 trillion GDP of 189 developed nations globally, and where SMEs contribute about 50% of that GDP, the impact of a 20% one-year failure rate is enormous. It is an $8 trillion impact with downstream effects and side effects. The downstream effects can be the impact which that small business had in a supply chain where that business provided materials, goods, or services to other businesses, disrupting their workflow. Side effects are that of tax base erosion, employment impact, and even economic instability to a community. I grew up in the greater Pittsburgh area, and whenever steel mills and glass factories closed in the 1970s and 1980s, the region suffered tremendously. So, what causes business failures? What does evidence and data show as the top reasons? There's a very common mode of failure for small and medium-sized enterprises. That mode of failure is an unsustainable profit performance, leading to the depletion of their cash or operating capital, and therefore causing them to cease operations and close their doors. The top reasons of this phenomena, but not the underlying causes, are low demand for their products and services, lack of competitive advantage, incorrect pricing and valuation of their products or services, weak understanding of the overall true cost of doing business, inventory mismanagement, inadequate planning leading to reactive behavior, and inadequate financing. So what are the underlying causes of business failures? What do the evidence and data show? The top causes of business failures fall into three categories: marketing-related factors, operations-related factors, and management-related factors. Let's start with the top factors for marketing. First is weak understanding for the demand of the firm's product and services. This may be where the firm did not gather enough reliable intelligence on the market demand. Second, an unclear, unique value proposition. It's possible the firm did not have a market position showing how they differ versus their competition. Third is the wrong product or the wrong target customer. Fourth is that the pricing does not reflect a benefit or value to the targeted customer over their alternative solutions. And fifth is lack of a competitive advantage. The overall product, price, performance, and/or quality is not substantially better than the leading competitor. The next set is operations-related factors. This is generally sourcing, production quality, and fulfillment. The top factors in this category include product functionality, quality, or availability, which doesn't meet the customer needs, poor demand management, which may mean too little inventory, too much inventory, or the wrong inventory, where doing business with this firm is too difficult, and finally, poor customer service in resolving problems. The third set is management-related factors. Generally, these are planning, navigating change, and finance. These factors include the lack of sufficient planning and proactive behavior, leading to highly reactive decisions and very erratic management behavior, general inexperience and lack of specific business knowledge, weak understanding of the true and total costs of doing business, and inadequate financing and financial management. Let's explore how business failure can be prevented. First, some good news. All of these underlying causes of business failures are generally preventable. However, one important concept is that failure prevention is not the same as a recipe for success. Top factors of business success are covered in our next episode. Starting with management factors, research shows the top factors for avoiding business failure are to, first, have a viable initial business model. In episode 4 of this series, entitled How Businesses Work, we introduced and defined the business model. It is basically a plan as to exactly how your firm intends to make a profit and the key success factors in doing such. Second is having a detailed business plan. This entails expanding the business model into a set of defined business strategies and tactical plans as to how the business will operate and execute over the forthcoming year. Third is having a regimen of recurring business vitality reviews. This compares the firm's actual performance against that of the business plan, specifically identifying changes in the marketplace, factoring in the economy, changes in competition, and shifts in product demand. The outcome helps management define and/or navigate changes with updated business strategies. Fourth, general business acumen. Research shows strongly that a good knowledge of business basics, as well as strength in advanced topics, plus an awareness of market dynamics, helps a business remain very competitive. In the finance area, having a comprehensive view of all costs of doing business is imperative. Research shows that failed businesses have grossly misunderstood their total cost of doing business. And finally, in this arena, having arrangements for adequate financing is paramount. This means having adequate short-term cash flow as well as the ability to secure and service both short and long-term debt. Moving to marketing and sales, research shows the top factors for avoiding business failure are: first, evaluation of market need and opportunity. This means an objective view and assessment of the total market and the addressable market for your product or service. How big is your segment of the total market? What is your opportunity size? How big could your share be and why? Develop the right product for the right customers. First, who are your customers? What is their demographic and their psychographic? What are they needing that your product or service fulfills? Many firms are available to perform market research and product feedback to assist in understanding the customer's sentiment and perception of your product's value. Next, develop a unique value proposition. Considering the previous factor of having the right product for the right customer, why will they want to buy your product or service? How is it different? Is it higher quality, faster delivery, superior features, or lower price? Then craft your elevator pitch story as to how your firm is the obvious choice. Create competitive positioning. Consider where your business falls in the overall competitive space. There are many models available which contrast two variables such as price versus performance to plot where your product fits, overlaps, or duplicates another product. If your product is an exact duplicate, known as an also-ran, it is probably a good indicator to move its performance or price to a different vacant spot. And finally, in this group, ensure competitive pricing. Along with the tasks of developing the right value proposition, creating the right product, positioning it correctly in the marketplace, it must be priced to be of economic advantage to the buyer. You must also realize and know what you are selling. Is its value to the customer that of convenience, time savings, a money-saving device, self-indulgent luxury, or even a status symbol? These help with pricing and positioning. In the area of tactical operations, research shows the top factors for avoiding business failure are to ensure a timely delivery. Regardless if this is in minutes or weeks, set clear expectations as to the delivery timeframe and then meet that expectation. Operationally, that may mean that the production process has to be optimized and the workflow has to be streamlined for delivery speed. Second, have the correct inventory on hand to fulfill orders or production to meet that delivery expectation. Many tools and firms are available to help provide fast market prediction as to the current demand for your product. This addresses lead time and having the right inventory on hand. Third, create an effective customer service function. Surprisingly, research shows that customers can be more endeared to a firm who handles a problem very well on the first engagement, even more so than a firm which never has had a problem. Research also shows that if the customer must endure multiple calls or handoffs to get a problem resolved, the hate factor becomes very high and the firm will likely lose any future opportunities for that customer. This negatively affects what is known as lifetime customer value and therefore has significant long-term consequences. Finally, it is imperative to deliver a quality product. It is often said that the bad memory of poor quality is remembered far longer than the short-term joy of low price. In closing, evidence shows SMEs have very high short-term failure rates. It also shows there are very common underlying causes of those business failures, and that most of these issues and their underlying causes are preventable. In this episode, we discussed the top failure prevention factors, but it deserves to be repeated that failure prevention is not one and the same as a recipe for success. Success also requires things like innovation, solution synergies, capitalizing opportunity, and other factors. On that note, factors for success are covered in the next episode. We hope to see you there. Thank you for joining us.